really glad you're with us today. Ready to get into something pretty fascinating. We're zeroing in on FOMO, fear of missing out. Now, we usually talk about this with, social media, seeing friends' trips, but today we're hitting it from a different angle. Financial trading and investing. It's a whole other beast there.
That's exactly right. On social media, maybe FOMO just makes you feel a bit envious.
Yeah.
But in the stock market, it's way more insidious. It's not just a feeling. It can genuinely be what we call a silent account killer. It just eats away at your capital without you noticing.
Silent account killer. Yeah, that really nails it. It sort of creeps in, doesn't it? Influences your choices. And yeah, silently chips away at profits. Often you only see it later. Looking at your balance like, what happened there? So for this deep dive, we've gone through this really insightful podcast script aptly named FOMO, the silent account killer. Our mission to really unpack what FOMO means when you're looking at charts, making quick calls in finance. We'll dig into the real consequences, the psychology behind it, which is fascinating, and crucially, equip you with some solid strategies, ways to spot it, and importantly, control it. We want to give you a shortcut, really, to understanding this emotional trap so you can make smarter, more rational decisions. Okay, let's unpack this.
Indeed. And I think to really get a handle on FOMO in the markets, we first need to acknowledge something fundamental. It's the role of, human psychology in how markets behave. It's often underestimated. The market isn't just numbers and algorithms. It's a reflection, really, of collective human emotions, biases, impulses. Understanding those emotions, especially your own, it's paramount if you want to navigate it successfully or even just survive.
So let's get right into it then. What exactly is FOMO when we talk about trading? Because like we said, most folks think, friends having fun without me, not watching stock tickers. What's the trading flavor of FOMO?
Yeah, good question. It's a crucial difference. In trading, FOMO is this really intense emotional reaction, often triggered when you see something moving fast, rapid gains, momentum. It's that overwhelming urge you get when a stock is just climbing and climbing or a whole sector is rallying hard and you're not in it. The fear underneath is that if you don't buy right now immediately, you'll miss out. Miss out on this huge profit everyone else seems to be grabbing effortlessly.
Oh, I can definitely relate to that feeling, maybe from earlier days. You see a stock mentioned everywhere, news, social media, friends, and it feels like this bullet train is leaving the station and you're just scaling there watching it go. That instinct to just leap, even without checking your ticket first, it's incredibly strong. Our sources really hit on how it overrides logic.
Exactly. And what's so interesting, and what the source material really explores, is how FOMO just completely short circuits rational decision making. It's less about, calculated risk versus reward, and much more an emotional reflex, a response to what feels like social proof and potential missed money. This impulse pushes you to jump into a trend, often and unfortunately right near its peak, buying high. And then the moment the market turns, which it always does, eventually your losses come out really, really quickly. You're acting out of that fear of missing out, not disciplined analysis.
You said it bypasses rational decision making. Can you unpack the why a bit more? Like what's going on in our heads that makes us ditch logic when FOMO hits?
It's deep-seated psychologically. Our sources make this very clear. Our brains are kind of wired this way, actually. We're programmed for social validation to avoid being left out. It goes way back to our tribal survival instincts. When we see others making money, especially if it looks easy, bam, big dopamine hit. Activates the brain's reward system, amplifies things like social proof and herd mentality, makes us feel like we're falling behind. And this primal fear, it often leads straight to those impulsive, often damaging actions. It overrides the critical thinking part of the brain. It's almost like a neurological shortcut.
Wow, that's a powerful way to put it. It's one thing hearing it theoretically, but it really lands when you think about actual examples. I mean, many of us remember the 2021 bull run, right? Especially for tech stocks. Felt like something new was exploding every single day, or even NFTs.
Absolutely. And our sources definitely point to periods like that as prime examples. We saw it so clearly in crypto, too. Remember Bitcoin crossing $60,000? There was this feeling everywhere, amplified by social media, that if you didn't buy then, you'd just never get another chance. It'd create this huge wave of FOMO buying, people selling other things, even taking out loans. And you saw similar patterns with certain meme stocks, those high-flying tech names, where the whole to-the-moon narrative just took hold.
And what was the immediate fallout for people caught in that Bitcoin wave or the meme stock frenzy? What's the bigger lesson there about market cycles?
Well, yeah, this is where FOMO really shows its teeth as that silent account killer. And it fuels what our source script calls a major wealth transfer. People caught in the hype, the euphoria, the fear of missing out, they bought right at the tops. Then, market corrects, drops 30%, 40%, sometimes way more. And those same people, now gripped by sheer panic, they sell near the bottom. And this cycle, it's tragic really, but it facilitates one of the biggest wealth transfers. Large investors, institutions, sophisticated algos, they often systematically sell their shares into that euphoric retail buying fueled by FOMO. They take profits, only to then buy those same assets back, much cheaper, when the market tanks and those retail traders panic sell in capitulation. The bigger lesson. Market cycles are driven by human emotion, and those who can stay detached act rationally. They often profit from the herd's irrationality.
That is a stark reality check. It really makes you confront your own biases, doesn't it? I remember earlier in my own investing feeling that exact pressure. A friend kept talking about profits from one particular stock. I hadn't done the research, it wasn't in my plan, but just the social pressure, the idea of easy money, it got to me. I jumped in and bam, like a 15% drop almost immediately. That was a sharp, painful lesson in FOMO. Reading our sources now, I get the psychology much better.
That's a perfect example of how our own psychology trips us up, even when we think we're being logical. It's this potent mix, isn't it? Greed, wanting the quick buck, and fear, terrified of being left behind. Throw in a heavy dose of herd mentality, and, well, you've got a recipe for trouble.
Precisely. And that herd mentality seems especially dangerous in markets because it creates these sort of self-fulfilling cycles, pushing things to irrational highs or lows.
Exactly. What's fascinating, and a pattern our sources consistently point out, is that the market often peaks when everyone is most euphoric, convinced it can only go higher. And conversely, the bottom usually hits when fear is absolute. When everyone thinks it's game over, the market will never recover. FOMO pushes you to enter when euphoria is maxed out and potentially exit when fear is peaking.
Yeah.
That's fundamentally the opposite of a winning long-term strategy.
Okay, but isn't there sometimes a case for reacting quickly, like to genuine breaking news or a real technical breakout? How do we walk that line? Balance being agile with, avoiding FOMO. How do you tell a real opportunity from just an impulse?
That's an excellent question, a real devil's advocate point, and it really gets to the core of disciplined trading. The key difference really boils down to the plan and the evidence, a genuine opportunity. That's when an asset fits your predefined strategy. There are clear fundamental reasons or technical signals for the move. And crucially, you have a calculated entry point, an exit strategy, and a risk management plan already flowed out. You're reacting to data and strategy. FOMO, on the other hand, it's all impulse, no plan, driven solely by that fear of missing a trend everyone's buzzing about. It's like the difference between playing chess and playing whack-a-mole, right?
Yeah, I like the analogy. So, how does someone, a trader, or really anyone making investment choices, start to spot if they're actually falling into that FOMO trap? What are the concrete red flags we should look for based on our source material?
Our sources highlight some really simple but critical checks you can do, a sort of self-assessment. First, are you thinking about or making a trade without a predefined plan? No clear entry, target, or stop loss level. Second, are you suddenly jumping into things, stocks, assets that weren't even on your radar just because they're hot on social media or in the news or friends are hyping them? And maybe most importantly, do you feel that intense last chance feeling? Like if you don't buy right this second, this specific opportunity is gone forever, never coming back.
Oof, that last one, that really hits home for me, and I bet for a lot of listeners too. That train leaving the station feeling is just so powerful. But why? Why is that specific feeling so potent, psychologically speaking?
That train leaving thing taps directly into what psychologists call scarcity bias. Our brains are just wired to place higher value on things that seem scarce or limited. So, in the market, if you see an opportunity as fleeting, exclusive, your brain automatically assigns it more importance, more value than it might objectively deserve. It triggers that urgency, bypasses rational thought. Scarcity bias makes us act impulsively. We fear the loss of the opportunity more than we desire the actual gain based on merit. And that, right there, is the mistake. Our sources strongly advise let that train go. What's fundamentally crucial to grasp and what separates successful traders from FOMO victims is realizing another train, another opportunity always comes along. The market isn't a single event, it's a continuous flow of possibilities. It's the ultimate paradox, really. The perceived loss of missing one opportunity is actually a gain in preserved capital and strategic patience.
That's a really profound shift in thinking. Okay, so we've identified the problem, we get the psychology, we can see the warning signs. Now the big one. What's the solution? How do we actually control FOMO and stop it from being that silent account killer? Our source material had some really good strategies.
It did, and they aren't overly complex, which is the good news. There's simple, practical steps you can take to build that discipline. First, have a predefined trading plan. Seriously. Before you even think about entering, know your entry level, your target profit point, and crucially, your stop loss. That stop loss is your safety net, the preset price where you automatically sell if things go against you, limiting the damage. It should all be crystal clear beforehand.
Having that plan really does sound like it pulls the emotion right out. Like you said, following a roadmap instead of just, driving blind.
Exactly. The plan acts your emotional shield. It's your logic taking charge. Second, practice disciplined position sizing. Always limit how much capital you put into any single trade. Manage your risk. Don't ever bet the farm on what feels like a sure thing. This automatically lowers the emotional temperature of any one trade.
Right. So if one trade does go wrong, it's a manageable hit, not some disaster that sends you into a panic spiral.
Precisely. Okay, third, keep a trading journal, a daily one. Make a specific note of every trade you even suspect might have been FOMO-driven. Write down your emotions at the time, the market situation, what triggered the impulse, and critically, the outcome of that trade. When you literally see in black and white how often those impulsive FOMO trades lose money compared to your planned ones, you'll naturally tighten up. It builds personal pattern recognition of your own bad habits.
That's brilliant. Seeing your own data, how FOMO actually hurts your results, that makes it undeniable.
Fourth strategy, always wait for confirmation. Don't just buy because the price is moving fast or there's hype. Wait for objective signals, maybe technical indicators on the charts lining up, like a stock breaking a key resistance level, or a moving average holding as support, or wait for actual fundamental news, strong earnings, a positive industry shift, something solid that genuinely aligns with your strategy. It means you're acting on real data, not just gut feel or crowd excitement.
So it's about validating the move, confirming it has substance, not just chasing the noise. Okay. What about our mental game? Is there a mindset shift that helps?
Yes. That leads perfectly to the fifth strategy, and honestly, maybe the most powerful one our sources emphasize a profound mindset shift. You have to truly internalize deep down that market opportunities are genuinely unlimited, infinite, really. If you miss one today, if that train leaves, another one will show up tomorrow, next week, next month. The market constantly generates new chances. It's about cultivating what you might call an abundance mentality in trading, instead of operating from a place of scarcity.
That's fascinating because it completely flips the script on how so many new traders feel, right? The constant pressure, market opportunities are unlimited, but your capital isn't. That has to be used carefully, strategically.
Wow, that's such a critical point. How do we practically, build that abundance mentality when there's so much noise telling us to hurry?
It takes conscious effort, cognitive reframing. When you feel that FOMO pull, you literally have to tell yourself out loud if needed. There will always be another trade. My capital is precious. I only deploy it when my rules are met, not the market's rules, not the crowd's rules. It's about developing patience almost as a superpower in trading. And if you zoom out, it's about shifting from being emotional and reactive to being rational and proactive. Grounded in your own analysis, your own plan, not swept away by the collective, often irrational mood swings of the market. That disciplined approach is how you tell a real opportunity from a FOMO impulse. One is based on your work, the other on fear and hype.
Yeah, that makes so much sense. Look, remember, FOMO is natural. It's a human emotion tied to our social wiring. And this is key for anyone trading or investing, it's absolutely manageable.
Yeah.
When you make that conscious choice, that deliberate effort to trade with emotional detachment, sticking to your plan, your chances of survival, let alone success in the market, they genuinely increase massively, maybe even tenfold, as some suggest. It's a total game changer.
So, wrapping this up, what does this all mean for you listening right now? Next time you feel it, that market train pulling away, that urgent need to jump in just because everyone else seems to be, take a breath, a deep one. Pull up your trading plan, check it. Actively, consciously, fight that urge to just react impulsively and remind yourself of that core mindset shift we talked about. Market opportunities, unlimited. Your capital, very much limited. Your money has to be used wisely, strategically, without emotion messing things up.
Because in trading, missing a trade is always better than losing capital.
Missing a trade is always better than losing capital. Just
Mhm.
let that sink in. It's such a powerful reframe, isn't it? It completely changes how you think about discipline and protecting your money.
Absolutely. It encourages you to consider the long game. Prioritizing keeping your capital safe over chasing every perceived gain fundamentally shifts your entire approach.
We really hope this deep dive gives you something valuable to think about, maybe something to reflect on and apply in your own journey, helping you navigate these markets with a bit more clarity, a bit more control.